Good afternoon. This is Taylor Hudson and Hugh McNaughton here from Sprague Energy with our market brief. It's been a couple weeks since we spoke with you last. Thanks for joining us again. Hugh, let's start with a big news story this week, Hurricane Isaac, obviously. Didn't look like too much of a wind event, more of a rain and a flooding event. What do we got out there right now in terms of where we stand for impacts on the refining infrastructure from Isaac here on Friday afternoon?
Well, Taylor, I think we've discussed this. It's clearly relatively minimal. I believe there's one refinery or that remains maybe questionable. It is a large one. It's ConocoPhillips 247,000 barrel a day refinery south of New Orleans. But even that, the refinery owners are saying they are still assessing the damage, and it doesn't look like it's necessarily going to be a problem. Other refineries are all scheduled, slated to come back on stream, as is most of the infrastructure, certainly the producing infrastructure. In many ways, I mean, this was a Category 1 storm, and that's what it turned out to be.
Since Katrina and Rita, have there been a lot of improvements overall, or what's your sense of how well we might fare if there's another storm that comes a little bit later?
I feel strongly about this. There have been millions, if not billions, of dollars spent on measures taken primarily against flooding, because that's the major concern in the event of future hurricanes. And I think it's going to have to be a pretty serious event to really cause a major disruption or any damage.
Good. Let's hope that we don't have one. In terms of the hurricane forecast right now, there are a couple out there. I think Kyle and what was the other one?
What's her name?
Leslie. And both of those seem to want to curve north and head into the North Atlantic. I think the Leslie storm, or the L storm we should call it, may actually pose a threat to Canada, maritime Canada, something like that. So let's hope that we don't get any more of those.
Excuse me, just one thought, Taylor. We are now at the midpoint of the most active part of the hurricane season, and that's August and September. So obviously we've got a little while to go, but we're also halfway through.
The other one I wanted to talk about today, Hugh, was all week long in Market Watch. You've been talking about monetary policy announcement by Fed Chairman Bernanke in Jackson Hole. I don't know why he had to go all the way to Jackson Hole to make the announcement, but
golf courses are good at it.
But what exactly did he say today? We had CNBC on mute in here, but I saw some flashes of quotes. So what was the overall announcement today? Did the market get what it had hoped it would get?
Well, judging by its behavior, it certainly did. But in my opinion, and a lot of other people's opinion are more qualified than myself, I'm not sure that he said a lot. He indicated an openness to a potential further stimulation. He certainly focused on the costs of the liabilities associated with it. Maybe the most interesting thing, in my opinion, is his defense of the last two rounds, QE1, and QE2. Indicating maybe a readiness or at least potential for justifying in advance another shot somewhere down the road.
Well, September should be an interesting month, I think. We're going to get a lot of news over in Europe as well. They're off the August recess. The German Supreme Court's going to decide whether or not it's even constitutional for German banks to buy, or I should say the ECB, to buy sovereign debt from places like Spain and Italy and Greece. So for those, we're definitely in a pattern of positive economic news, and looking like we're going to solve these crises tends to lead to the oil market wanting to go up, along with financial markets. But as soon as we get some headlines about some disagreement or imminent deadline that's not going to be a problem's not going to be solved by policymakers, we tend to see the markets go down. I guess since we've had a summer where everything seems pretty good, one might argue that we're due for some news that things don't seem so great. So we'll definitely be watching. Another topic we wanted to touch on briefly was we're obviously Next week is September 1st. It's almost the heating season. Everybody here is excited about that. And we're getting some calls and questions about inventories headed into the season. So what we've got here is a picture of total distillate stocks for the U.S. So this does include diesel fuel as well as heating oil. And you can see, let's see if I can make that pointer work again. Here we go. You can see that versus the 5-year average, current distillate inventories at about 126 million barrels are below the 5-year average heading into the winter. So that might be considered worrisome. And versus last year, we're 30 million barrels less than we were same time last year. Interesting to note, though, that we are roughly in the same ballpark in terms of outright price, $3 area. Hugh, what's your take on total U.S. distillate stocks and this 30 million barrel deficit to last year? Is it something we should be concerned with?
The numbers are dramatic. Obviously, those are some pretty powerful statistics, and it's a big deficit. In my opinion, though, no, we still have some time. Refinery production is running pretty healthy at 4 points U.S. production, overall production, 4.6 million barrels. Under normal circumstances, in past years, we'd have had no difficulty meeting regular targets. What's happened here is that over the last several months, U.S. has been exporting well over 1 million barrels a day, probably 400 to 450,000 barrels a day more than we have in, say, in the past 5 years. In response to strong overseas demand, that overseas demand is beginning to taper off, or should come off as European refineries kick back in and new refining capacity, particularly in Asia, comes online. So once that demand tapers off, the refineries U.S. refining should continue to maintain the same output levels. Margins are relatively strong, and you divert 1 million barrels a day into building U.S. inventories. It doesn't take a very long to make up a 30 million barrel deficit.
There's another good. A year ago, we were talking about all the refineries that were going to be shut down, and now we're inundated with reports of cheap Bakken or Canadian tar sands production moving east and giving new life to these East Coast refineries. What a difference a year makes. If I go to the next slide, this is not all distillates. This chart is East Coast or PADD 1. Inventories of distillate fuel greater than 500 ppm sulfur. So this is a chart of essentially how much high sulfur heating oil is on hand on the East Coast right now. Current inventory levels 20.5 million barrels, and perhaps this is a testament to don't let the inventory levels ahead of the season guide your price forecast, because if we look at the last time we were at these levels, it just so happens to be in July of 2008, and we all remember very well what happened as we came out of summer of 2008 and went into the winter of 2009. Price plummeted. So the fact that we have low inventories, headed into the winter by itself does not necessarily mean there's going to be some flat price spike. And I think we can sort of speak from Sprague's perspective here. There's nothing that we see out there that's dramatically changed that would tell us that we're not going to be able to get high sulfur material, or the product is readily available and we will be able to meet our supply commitments. This last one, I'm sure our listeners are sick and tired of hearing us talk about it, but we wanted to bring you up to speed again on the price spread in New York Harbor between ultra-low sulfur diesel and high sulfur heating oil. This is very important because we had a dramatic change in this market starting on July 1st when New York went to ultra-low sulfur heating oil instead of high sulfur heating oil. As a result, and on this chart, you can kind of timeline that July changeover period. Up to that point in time, really the spread where ultra-low sulfur diesel comes out of the winter and because high sulfur is in less demand, the price goes down relative to it, so the spread widens out. The market had behaved quite normally. And then, Hugh, you and I have been talking since July 1st. We've been kind of monitoring this spread, and that's the purple line you see here. And we've seen some spikes, and now, really, here at the tail end of August, we've seen quite a dramatic shift away from what we'd call the norm. Over the last week or two, we've been trading in the high 13s to mid 14-cent price difference. So this week we saw ultra-low sulfur diesel one day valued at nearly 15 cents higher than its high sulfur counterpart. Everybody's question is, what's this going to do going forward? Because it will have a ripple effect into rack pricing, certainly between the states of, let's say, New Jersey, Connecticut, Massachusetts, Vermont, and the state of New York. What do you think, Hugh? Where is this spread going?
Well, let's hope it's not. Let's hope it's not going to stay where it is now, because it sure does represent a challenge for our New York State customers and retailers in general, who are looking to try and obviously get themselves and their customers converted over to the idea of something that now costs 14 cents a gallon more than what it would have a year ago by virtue of being a different grade. My thought is, like yours, I think it's going to. It can't be sustained here. Looking at that chart, I mean, you can see how historically that's really, really high. Whether or not it gets back to sort of seasonal levels, which you can see are averaging what, maybe somewhere between 5, give or take 5 and 10. Okay, 5 and 10 cents is somewhat open to the question. There have been some very structural changes. I think we discussed those, and I think you could probably do a good job of describing what we thought there.
Well, like you said, I guess my take is I think the seasonal tendency is obviously for people, once we get some weather, to start bidding up for high sulfur material relative to the low sulfur counterpart. That in and of itself will drive the spread lower when heating oil kind of moves up in value. However, it's interesting that we were looking back at some numbers, Hugh, and we came up with something like 19% of total Northeast heating oil was New York State. You now have that not being needed in New York, and instead you have the ultra-low sulfur being in demand. So I think, like you, that the spread will act seasonally and that it'll go down from these 14-cent levels. But my guess is probably that we're not going to necessarily see the 2 to 5 cent range that we saw. I think we could bottom out somewhere closer to maybe an 8 to 10 cent price difference. But who knows? No one's sure, and we'll obviously keep a close eye on it. Figuring that we don't have anything, figuring that we haven't talked about depressing topics enough, people are starting to look at the weather, and don't kill the messenger. But all I did was I went on the NOAA website and looked at their current temperature outlook for Jan, Feb, March 2013. And when you see orange on temperature charts like you do here for the northern half of the country, that's not good for the heating oil folks. And so the government right now is projecting an above normal potential for a warmer winter. I'm not sure what the other forecasters are calling for. Hopefully they're calling for something different, but it is what it is. So what do you think?
Well, the same old, if we can't forecast what's going to happen on Monday or Tuesday, are we really forecasting now what's going to happen in March? It is actually a reflection of the standard La Nina, which is the current surface or subsurface, whatever surface temperature, something like that. Anyway, right? Isn't it? So cold, colder and stormier in the north, warmer in the south. That's lots of time.
No, this is opposite of that. This is saying warm in the
Oh,
north.
is that? Oh, I see. Oh, okay.
All right, never mind. All right, so let's wrap up on the technicals. Hugh asked me to just present a technical chart real quick, and so I figured, we've been in an uptrend for quite a long time. well, it seems like a long time, July and August here. But I just pulled this chart. This is a 12-month chart. So right back here was, where was heating oil and diesel fuel pricing roughly a year ago. And lo and behold, we were trading between $3 and $3.10. So today looks like we're going to end the day somewhere around $3.16. So really, over the last 12 months, we've moved 20 cents on either side of $3. We had a nice downturn here in the late spring, early summer. We went down to $2.60, and now we're coming right back to this $3 area. Short term, the market needs to get below the 9-day and the 18-day moving average to have any shot of really bringing on any serious selling pressure. And every time we've had the market fail to make new highs, like we did here, and if we go back to here, every time we've done that, the market really hasn't been able to break through even the first level of support. The one time we did was right here, looks like mid-July, but the 18-day moving average stopped it in its tracks. So until we can do that, the tendency is going to be to follow the bulls and continue that. What happened yesterday is going to happen again. We're going to keep going up. But like we saw back in May and June, there is a little bit of, hey, this move is overdone at play here. When the market was going down, 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 we just kept getting further and further away from, the longer-term moving averages, and the market corrected. And here we are in early September with a very large difference between where the price is currently, say 316, and where the longer-term moving averages are of 296. So for those of you who believe in sort of reversion to the mean or an ebb and flow of markets, now we have a better chance now of seeing some sort of pullback than we did even 3 or 4 weeks ago based on that alone. So I think we're all hoping that that's the case. So Hugh, thank you very much, and thanks to our listeners, and we will be back soon. Thanks for listening.